Welcome, everyone. I'm just waiting for Greg to log on and show his screen so we can get the webinar started. But this is Clint Coons with Anderson Business Advisors and Law Group. I want to thank you all for taking the time out tonight to join us for this very important webinar on planning for your retirement. You know, it's one of the things that I've been talking a lot about lately with individuals that I meet at our events and just, you know, on the phone in general. When it comes to retirement savings, I've been asking people, you know, do you think you're going to be better off when you retire or worse off than you are today? And a lot of us have preconceived notions about our retirement, how much income we're going to need when we retire. And the way I always relate it to people is that I look at retirement as vacation. And I know that when I go on vacation, I spend more money than I do when I'm at home. And so I want to make sure that I have sufficient funds available for me when I retire so that I'll be able to live the lifestyle that I'm accustomed to, or at least my wife's accustomed to. So it's really important that when you're saving, you're looking at the various options that are out there. And one of the things that Greg has been very instrumental in working at with Anderson is showing people how to invest through pension plans and now through these non-qualified plans that produce tax-free income upon retirement. Because let's face it, taxes are probably going up. I mean, we have to with what's going on out there in the economy. And it's a concern of everyone's that, you know, what is going to be the value of your income when you retire? Well, Greg has found a solution for that, and tonight he's going to be presenting on this particular subject matter, which I think you'll find very informative and eye-opening. So with that, Greg, I want to thank you for being on the call and let you take it from here.
Thanks, Clint. All right, sounds great. Hey, welcome everybody. It's great to be here. What we've done at Anderson, you know, working with our clients over the last 16 years in regards to their retirement plan savings, we've seen so many people just go on a roller coaster ride in regards to having gains and then losing all of those gains in market corrections, losing potential gains in real estate market corrections. And so what we've been doing is we've been focusing then on ways for clients to help preserve the capital, because we want to make sure that when it comes to retirement, yeah, we can treat it like a vacation. We don't necessarily have to go and work. If we work, it's because we want to. And unfortunately, the reality of the situation is that within the country, there's a huge retirement planning crisis going on right now. Social Security is currently set to expire in 2033, and you know, that's not doom and gloom prophecy. That's just a fact in terms of we're at the point now where more people are starting to draw out than are paying in. And so we have options. That's the good thing. We have options in regards to planning for our future. And the way that most of us go about doing so is in regards to making contributions to our traditional IRAs, and if we can meet the income limitations, we can make contributions to Roth IRAs. And then on the qualified, and this is where I work with a lot of our clients on, we have our defined contribution plans, our 401A profit sharing plans, our 401Ks, our Roth 401Ks. And these are all excellent vehicles just in regards to putting funds aside for a later date in hopes that we'll be in a better position in the future. But there's a downside just in regards to putting all of our eggs in these traditional baskets, is that they're all subject to market loss unless we're parking everything in cash. When we have those market corrections like we saw back in 2007 through 2009, people took a tremendous hit in regards to their retirement savings, and we've been clawing back for the last several years, where now most people are right about where they were 10 years ago, 12 years ago in regards to their retirement plans. So tonight what we're going to focus on is just in regards to some non-qualified options that we have, a private retirement contract. It's what is known as a 7702 contract, and as we'll see, as the webinar progresses, there's fantastic opportunities in regards to tax-free income being generated, not only for our retirement, but for any time that we desire. And unlimited access to that capital, where we're not having to jump through all the government requirements that we do within our qualified plans and our IRAs in regards to when we can access those funds and how we can access those funds. But the solid foundation to any type of planning is you have to have an understanding of where you're currently at and where you want to be whenever you define what your retirement age is. And based upon the feedback that we had for today's webinar, is that on average, you guys as attendees, you're doing well in terms of you're setting aside on average between $5,000 and $10,000 a year, which is much is in this country. And so you are just look at, well, how old are you and how much do you want to have when you retire? So I made up this hypothetical in regards to John Doe. John Doe is an average person. He has $45,000, or he's age 45. He wants to retire in 20 years at age 65, and he's diligently putting away $10,000 a year into his employer's 401k. Now, John wants to be able to have in 20 years $60,000 a year to supplement his retirement so he can go on that permanent vacation. The problem is that John, like so many other clients that I work with, we fail to look at one overriding factor when we're calculating out numbers, and that's just in regards to the eroding effect of inflation. So anytime you're doing a calculation, you want to look at the inflation rate. And on this hypothetical, I did a fairly conservative rate of 2.5%. Historically, it's higher than that, but I think this is a good solid foundation to work off. So John wants to have $60,000 a year 20 years from now. The problem that John faces is that based upon inflation, he's going to actually need to be pulling out almost $101,000 to have the same purchasing power of the $60,000 today. Now, John has other assets available. He has $100,000 total in his qualified plans. He also has $250,000 in cash, $20,000 in a Roth account, and his anticipated Social Security income on a monthly basis, if he waits till full distribution age at 67, will be right around $1,200 a month. Now, within this scenario, I'm basing these numbers on a consistent guaranteed 5% rate of return, not subject to market loss. And then also we're basing it on that when John retires, he's just going to be in the 30% tax bracket as opposed to some higher tax bracket that we have no idea what's going to be coming down the road. I would hazard to guess it'll be higher than John's 30% based upon the new pattern of redistribution of wealth, but we have to start somewhere. So John is diligently saving $10,000 a year for the next 20 years within his plan. He goes and retires at age 65, and he wants to be able to pull income out because he's going to live a nice long life up to age 100. So his before tax distribution based upon a guaranteed 5% rate of return of those funds is $35,000. The problem that John has is that these are before tax dollars. The reality is that 30% tax bracket, his actual take home is only $24,678, which is an even bigger problem for John, is because he wanted to have up to $100,000 in income to live off of when we index it for inflation. The issue here is he has a $47,000 shortfall income gap, which is a major issue when you're in retirement where you're living pretty much now on a fixed income source. What's John going to do to meet that income shortfall? He has to postpone his retirement. He might have to get a part-time job. He might have to dramatically modify what he wants to do in retirement based upon his income. The best thing though here for John in this hypothetical is that none of his funds are subject to market loss. But the reality is anytime we get that low, downside risk. And so I want to illustrate what would happen if we were getting an 8% rate of return. You started with $10,000, and you're getting no positive return. That's why they're making all of that $10,000. So I just hear next. I did the church say that loss for 1 year, 5 years.
Hey, Greg. Greg, your audio is not coming across very well right now. You're breaking up really bad. Can you possibly redial back in?
Yeah, let me hand it over to you, and then I'll redial back in on the other line.
Well, now I can hear you right now. Yeah, why don't you dial back in and pick up on the handset?
All right, can you hear me okay now?
Yeah, I can.
Okay, well, now that I'm standing on one leg, we're good to go. So with the market loss of this 20%, well, I look at that. Hey, I have a 20% loss. I ask somebody, well, what do you need to get to make up for that 20% loss? And the average person will say you need 20% return. But that's not correct. For that 20% loss, I need to have 25% profit just to break even. And any one of us that have had any type of retirement account or even just a brokerage account within the last 13 years, I would imagine we were all in the same boat where we saw some type of loss, especially back in 2008 and at the beginning of 2009. And a real conservative loss, when the market bottomed out, we saw almost a 57% loss. But on average, the people I talked to lost about a third, which is still a heavy hit. And unfortunately, just by losing 1/3 of their account value, the account had to have a 50% gain just to make up for that 1/3 loss that they experienced. So this is where I believe the real power in regards to non-qualified plans comes in. When we're looking at 7702 contracts, we have two main core components there. We have no risk of investment loss. And to add icing to the cake, the income, if we structure it properly, will come out to us as tax-free income. And so that's why we were talking, or Clint was talking about the unlimited Roth. In a lot of respects now, even though this is in a Roth account, it has similar benefits where the money is going to be coming out to us in a tax-free manner, which then allows us to minimize our inflation loss. So the net result is oftentimes we see upwards to a 40% increase of our income based upon these types of structures. Also, we have built-in asset protection, and we're not subject to all of the confines that we are within our traditional IRAs and our Roth IRAs and our 401ks in regards to having to limited access to the funds, potential 10% early withdrawal penalties on our traditional IRAs and our qualified plans. We get locked into having to do mandatory distributions at age 70 and a half. See, unlike those types of plans, this is a private contract. It's not a government-structured plan. And so we don't have all of those rules and regulations that we're generally used to having to deal with our IRAs and our qualified funds. So really what a 7702 contract is, it's a permanent life insurance policy. Now that in and of itself oftentimes just turns people off because we have these preconceived notions in regards to what life insurance is and what it's designed to do. So we have different types of life insurance. We have term insurance, which only lasts for a defined period of time, and then we have permanent insurance, which will last our entire lifetime. Now, on term policies, and this is where a lot of people are steered to, just in regards to advice from the pundits in Wall Street, we oftentimes hear buy term and invest the difference. And you know what? Hey, when I was 29 years old and my first son was born, that's exactly what I did. I bought a 10-year term policy with $1 million death benefit. And anytime you set up a term policy, there's really two bets that are going on. You or me, when I bought that policy, I was betting on the fact that I could die within that 10-year period. And if I did, I wanted to make sure that my wife and family had funds available to them if I was no longer around. On the other side, the insurance company is betting that you're not going to die. And so what ends up happening is that you survive that 10 or 20-year period, which hopefully you do. I was more than happy to still be alive after the 10-year period of my term policy. But when that was done, I was left without insurance because at the end of the term, the policy expires. And I didn't have anything to show for those premiums that I was putting into that policy because a term policy doesn't build up any capital with inside of it. It's pure insurance. And so then what I had to do is I still had those economic needs that I had before when I was 29. I had the same needs at 39. Now I had another child. I had additional expenses that I wanted to make sure that my wife and kids were provided for. Problem was I was 10 years older. So when I went out to acquire another policy, I was paying significantly more at age 39 than I was at age 29. So that's how term worked out for me. But I also, I followed their advice. I took the money that I saved on the term policy and I went out and invested it. The problem was that I lost a good portion of my principal when we had those market corrections. I also lost a portion of my principal just in regards to the real estate market corrections. So unfortunately, when it was all said and done at the end of that 10-year period, I had lost a significant amount of the principal that I had set aside by going with a cheaper insurance by having term. And I was 39 years old, and now I was without insurance. So that's a big problem that I have with that advice in terms of just buy term and invest the difference, because there's almost always going to be some type of economic need that you want that insurance policy to provide for. But when that policy expires, you don't have anything to show for it other than the premiums that you paid to that company. There's no capital accumulation. So that's where permanent insurance comes in and where it differs from term. Permanent insurance will last our entire lifetime. So I can buy a policy on a 2-year-old and it will last that 2-year-old's entire lifetime. And unlike a term policy, that permanent insurance policy will accumulate capital throughout the life of the policy. So there are two real good options that we have in regards to utilizing a 7702 for a non-qualified plan to have tax-free income and access to the capital. One of them is a whole life policy, what is known as a participating whole life policy, or it also could be called a mutual whole life policy. And where that differs from a publicly traded insurance company is that all insurance companies, they're federally mandated every year to set aside the required assets to pay out any guaranteed payments and any potential claims that they may have in that given year as far as death benefits, which is dramatically different than when we're dealing with banks. Banks work on a fractional reserve system. So when you deposit $100 in the bank is only required to withhold 10% in reserve. Insurance companies, they have to withhold much greater funds. And what ends up happening within these companies is they're very conservatively run, is that the actuarials, what they always do is they estimate a larger amount of potential payouts than actually occur in the given year. So what happens is then we have reserved profits or surplus. Well, within publicly traded insurance companies, what the board of directors may do is they may declare a dividend to the shareholders. And then so for the profits of that company, they pay out to the shareholders of the company. Participating life insurance companies, mutual life insurance companies, there are no outside investors. The policy owners are the investors within the company. And so they go through the same process in regards to setting aside capital to make sure that any mandatory obligations are satisfied or any potential obligations are satisfied. And then they end up with that same pool in reserve. And then the board of directors at that point in time, they can elect to pay a dividend. But the dividend is structured differently. Instead of going to outside investors, that dividend then goes back to the policy owners. And so we see nice, consistent rates of return within our participating whole life policies, our mutual whole life policies. Another great type of policy for this concept and this implementation is what is known as an indexed universal life policy. And oftentimes this is known as investment grade insurance. And it grows differently than the participating policy, because in an index policy, we can have growth based upon a guaranteed interest rate, and we can also have growth based upon underlying market performance. But unlike our 401ks or our IRAs, there's no downside risk. We'll see that regardless of whether or not the market drops 10 points or 100 points, we don't put any of our principal at risk. But the structure of these policies, they're not off-the-shelf policies. See, the traditional policy, whether it be a whole life or an index universal life or a variable universal life, almost always the main focus on these policies revolves around the death benefit. How much will that insurance policy pay out if you die while that policy is in existence? And so based upon that concept, we pay our premiums in there at the minimum amount. And so when we pay premiums into any type of insurance policy, the way that it works is that a chunk of our premium payment goes to cover the underlying cost of our insurance. So my underlying insurance at age 43 is going to be more than a 20-year-old, just because statistically there's a greater likelihood for me to die at any time as opposed to a 20-year-old. But when I minimally fund that policy, almost all of it is going to that underlying cost of insurance. And so this is another way that people jump on that bandwagon talking about, well, insurance isn't a good investment vehicle because it takes so long for the capital to accumulate. And I completely agree when you're funding it in a traditional manner. When we're only focused on the death benefit and we're funding that insurance policy to the minimum extent possible, it oftentimes will take us upwards to 15 years before the cash value in that policy equals the amount of premiums that we've put in. Now, granted, it's still growing, but 15 years, that's a long time just to break even. So we want to have a policy that's designed to accumulate capital at the quickest rate possible while keeping the tax-favored structure and also keeping the underlying cost of insurance down to the greatest extent that we possibly can, and also giving us the ability to borrow from that cash value at any time without having to jump through hoops. Because we're going to see it's that borrowing ability that is really going to change our retirement life, but also our access to funds pre-retirement. So it's not the run-of-the-mill policy. It's a really specially designed policy in order for this to work properly. So looking at how the dividend-paying whole life policy. When we start looking at the underlying benefits in regards to borrowing and protection, it doesn't matter whether you have a dividend-paying whole life insurance policy or an index universal life policy. They both achieve the same results. It's just how we go about getting there in regards to capital accumulation that they differ. So within this participating policy, the insurance company is owned by the policyholder, and then the board of directors then has the ability with that surplus, with those profits, to declare an annual dividend. Now, you need to know that a dividend is not guaranteed. Just like when we're dealing with investing in a publicly traded company, there's no guarantee that Microsoft is going to kick me out a dividend every single year. That's up to the discretion of the board of directors. And the same thing holds true in regards to dividend paying a whole life. But the reality is that these companies have been in existence for upwards to, some of them upwards to 150 years or more, and they have consistently paid out annual dividends. And the reason why they do that is they want to make sure that people continue to hold their policies with the company and they can get new policyholders in the fold. And so you can never assume that it's guaranteed, but you can count on it as being a pretty consistent thing. And so from a rate of return standpoint, we're generally looking at anywhere between a 4 to 6% rate of return with dividend paying whole life policies. Now, one of the real nice features in regards to these types of policies is that we have the ability to start small. Because what we always need to factor in, just like when I'm looking at how much I want to put in my 401k, when it comes to planning with insurance, what I first need to determine was how much premium can I pay. And I might be in a spot initially where maybe I'm just starting out in life, or I have a lot of outstanding debt, where I can only pay a minimal amount of annual premium. That's all right, because we can structure the policy in a way where it starts off as a relatively small policy, but one of the benefits of whole life is you can have what are known as paid up additions, and we can use those dividends that the board of directors declares. You can have the dividend come directly to you on an annual basis. You can have that dividend be used to pay your premiums. You can have that dividend just go to capital accumulation within your policy, or you can have your dividend used to buy these paid up additions. So these paid up additions, basically what they are is they're just smaller single premium insurance policies, where over time we're adding to the overall death benefit in regards to the insurance, which is important because the way that the board of directors determines how they're going to pay out these dividends is based upon the outstanding death benefit. Because a person that pays $1 million or has $1 million insurance policy is going to be paying a larger premium payment than somebody that has a $100,000 policy. So the size of the dividend, it directly corresponds to the underlying face value of that insurance. So with my $1 million policy, I'm getting a larger dividend than somebody that has $100,000. But I could start off with this $100,000 policy and add paid up additions over time, so my death benefit continues to grow, and I start to see a larger return just in regard to the dividends that are being declared by the board of directors. So these are great for people that might need to start small in regards to their overall planning objectives. They're excellent for people that want to see a nice, consistent rate of return. I have a lot of clients very attracted to these types of policies because they're concerned that we're right at the edge of another financial cliff, and we're going to see just a decimation of the market gains that we've seen this year and within the last couple of years. And so they want to be completely divorced of any market performance. And so the great thing about these policies is they have nothing to do in regard to the market. They just have the ability to pay out these nice, consistent rates of return. So it's a good option if that's the type of mindset that you have. Regardless of what the market does, these generate a nice, consistent rate of return. Now, on the other side of the equation is that many of my clients, and myself included, is I like to have the opportunity to maybe make more than that 4 to 6% annual dividend. And that's where indexed universal life comes in, because it has the ability to generate capital in a different way. Now, there's two different types of universal life policies out there. There's indexed and what is known as variable. And variable policies were really popular back in the late 90s, early 2000s, because within a variable policy, you were basically inside of the insurance policy buying mutual funds directly investing in the stock market. And everything was great within those policies while the market was going up. The main problem with variable policies is there's no backside protection. So when the market tanked, the value of those policies, the cash value inside, also was wiped out. And now people were confronted with positions where they were having to pay these more premiums into the policies just to keep them in effect, because they lost all of their underlying capital by being invested directly in the market. And this is why indexed universal life policies are so popular. Because within the indexed policy, you're not investing directly in the market. We have two different accounts inside of this policy. We have what is known as a cash account, and in the cash account, we can allocate our funds there, and it will receive a guaranteed interest rate. Right now, a lot of the companies are right around 3%. So I could park all of my funds on the cash account within my IUL, Indexed Universal Life Policy, and I'm receiving a guaranteed 3% return regardless of what's going on in the market. But you know what? I want to be able to participate more actively in regards to the potential for greater gains. So I can also allocate my funds over into the second account. It's known as the indexed account. And I can split these up 50-50. I can have it 80-20, 70-30. I can have 100% in the index side if I want to. I'm the one that gets to make those determinations. So the way that it works, and this is why it's called investment grade insurance, is that on the index side, what the insurance company's doing is they're allocating a certain percentage of the funds that come into the policy each year, and they're buying options on an index. So with just depending upon the type of policy that you have, you can have an index on the S&P 500, it could be on Russell 2000, it could be on NASDAQ, it could be on Eurostock, it can be a blended index. You have a lot of different options. But let's just go with the S&P 500. So if I want to allocate my funds for the index on the S&P 500, what the insurance company does is they take a portion of the funds and they'll go out and they'll buy an option on the S&P. And if the S&P goes up during that year period, they will exercise that option. And then so the gains will then go into the indexed side of the account. But what happens if the S&P goes down? Well, if the S&P goes down, the insurance company doesn't exercise the option. And by not exercising the option, the fact that the S&P goes down, what that's doing for me, it's protecting me, because the underlying cash value on this index account will not decrease. So my funds on the index side are never subject to loss. Now, worst case scenario is that if I get in an indexed account or put my funds in the indexed account and the market goes down, I'm just going to have a 0% rate of return in that account for that year. There are some insurance companies that will guarantee you a 1 or 2% rate of return, regardless of whether or not how far down the market goes. That's an option. We always want to explore, well, then what are they taking away? Because what ends up happening in all of these indexed accounts is that there are limits in regards to how much our account can increase. We have what is known as a cap within a policy. So for most insurance companies that have these types of policies, when we're looking at the S&P, the cap might be 13 to 15%. So let's just conservatively say it's a 13% cap. Well, what that means is that during that year that I had my funds in that indexed account, if the S&P goes up 13%, 100% of those gains will go into my account. But if the S&P goes up 20%, I only get the 13% gain. Well, what ends up happening with that other 7%? Well, by default, we generally think, well, it's the greedy insurance company. They're pocketing the other 7%. That's generally not the case, provided that we're using a good company. What the insurance company is doing is that they're going out and they're buying options from banks. And they're buying options already with these built-in caps. So they are going to buy an option with a 13% cap already built into it. So they're not making any more money if the S&P goes to 20 or 50% gain that year. They're just allocating those funds to buy that option for you, and neither you nor the insurance company is participating in the overage. So within our accounts, we have what are known as caps, or pardon me, a lock and reset feature. And so I set up my policy, and the S&P is at 1,600 points. And unfortunately, by the end of that first year, when I roll into year 2, the S&P is down to 1,200. So the S&P lost value. The benefit for me is that I didn't lose any money. No principal was lost in my account. I just had a 0% return within my account that year. So then I roll from year 2 to 3, and the S&P goes up. Well, at that point in time, that option is exercised, and then those profits will go into my account. Then I have what is known as, this is part right here at the 1,200, that is what is known as a reset. That's my new starting point. I go up to 1,300 the next year, then that's my lock. I'm locking in my gains. And then I start the new year, 1,300 is my new floor. And unfortunately, again, in year 4, the S&P goes down. Now, thankfully, I didn't lose any of the gains or any of the underlying principal. But in years 5 and 6, I get to participate in the gains from 1,000 to 14, and then I get to participate in the gains again from 14 to 1,600, which is very different than if you just didn't purchase the S&P directly. Because if we purchase the S&P directly in year 1, we have to wait all the way to year 6 just to break even. We don't get to participate in any of these upswing picks. And so that's why an index account is so powerful, is because we have this annual lock and reset. So worst case scenario, if the underlying index goes down, as long as it goes up that next year, we're never having to claw our way back. We always have a new starting point each year. And so looking at it from a real world perspective is that if I invested $100,000 in the S&P back in 2000, well, during that next 10-year period, I had 6 years of gain, but the problem was I had 4 years of loss. And unfortunately, there was a 9% loss between the year 2000 and 2010. So my original $100,000 investment, by the year 2010, it was only valued at $91,000. And that's what had happened to a lot of people just in regards to their brokerage accounts. And 9% during that 10-year period loss, that was pretty respectable. Most people lost much more than that. So that $91,000 that we have in the year 2010, that's not even factoring in the eroding effect on that money in regards to inflation, any load fees that I might have had to pay along the way, any potential tax ramifications along the way. Same scenario where if I would have invested $100,000 in an indexed account based directly on the S&P. Same 10-year period. Since that account never would decrease in value, we saw an annual compound return of 8%. So instead of only having $91,000 in 2010, those indexed accounts had $233,000 based upon the same market performance. But the principal was never subject to erosion based upon loss. So that gets us then to the point how these funds or how these policies generate capital. Regardless of the structure of the policy, whether it's a participating whole life policy paying out dividends, or it's an indexed universal life where you're getting a guaranteed interest rate, or you're participating in linked index returns, they're both identical then in regards to the benefits that we have once the money is in the policy. Because within our traditional retirement scenario, when we're putting our money in our IRAs or our 401ks, you know what? That money's locked. Within limited circumstances, we can't access those funds until we're 59 and a half without being subject to 10% early withdrawal penalties, or maybe I take a loan out, but my loan amount's capped. I can only borrow $50,000 out of my qualified plans at the most. Can't exceed 50%, and out of my IRAs, I can't borrow any money at all. Well, that's where these plans, these 7702s, are just completely blow other planning away because of the way that we get the money out of the plans. The way that we're accessing those funds, we have two different ways. You can do what is known as a surrender, and generally we don't want to do that because when you surrender a portion of the policy, what ends up happening is then there's potential tax ramifications, and you're losing a portion of your insurance coverage. The death benefit portion of it goes away. So generally, then, how we get the money out is we have them structured as loans, and this is 7702 in a nutshell, is that you can borrow from an insurance policy that you own, and it is not treated as taxable income to you. It's basically viewed as a return of premium. And so I like to view this then as my private vault. That money that's accumulating within those policies, within my IUL or my dividend paying whole life policy. And unlike the traditional policies that I was talking about earlier, we don't have to wait 15 years to see a return. Generally, we're seeing a balancing out of the premiums that we've paid in to the cash value within the plan, anywhere between years 4 and 7 within the policy. So when that money's in there, it doesn't matter if it's year 50 or year 1, I have the immediate ability to borrow from those funds. And this is where these plans are so phenomenal, is that as long as the loan is structured properly, the insurance company will treat the amount that you borrow as still being in the plan for growth purposes, which no other type of strategy will allow me to do that. I could turn around and borrow $50,000 out of my 401k tomorrow. Hey, that's great. I can use that money however I see fit, and I just need to pay it back over 5 years, or I get hit with an early withdrawal penalty and taxes. But the problem is when I borrow that $50,000 out of my 401k, it is no longer in my 401k. So it is no longer growing at a tax-deferred manner. With these products, these insurance policies, the insurance company, when they lend you money, they're basically holding on to your principal and using it as collateral. So if I borrow $50,000 from my policy, my $50,000 is still being treated as being in there for growth purposes, even though I have the $50,000 in my hand. And I'm not limited to $50,000. I could borrow $100. I could borrow $500. I can borrow generally up to 70% of whatever the cash value is within the policy. And so this is another factor that we need to keep in mind when we're looking at, well, where do we set these up? We want to make sure that we set up a policy with a company that gives us the ability to immediately borrow if we desire, It gives us the ability to structure the loan terms based upon our desires, not anyone else's desires, and they give us the ability to have those funds still being treated as being within the plan for growth purposes. Now, I can pay back the loan. I don't necessarily have to pay back the loan. Now, while I'm younger, when I'm borrowing those funds, I'm definitely doing so with the mindset that I want to pay back that loan. Because as long as I pay back that loan, that capital continues to grow. Now, again, I'm the one that defines the terms of that loan. I can pay it back over 10 years. I can pay it back over 2 years. If I miss a loan payment, not a big deal. I don't have those potential ramifications that I have within other retirement structures. When I reach retirement, well, then my thought process changes in that now I want to use these funds to supplement my retirement in an income tax-free manner. Because remember, that loan is not treated as taxable income. So I now have the ability to borrow that money, and I can borrow it out for the remainder of my life. Worst case scenario is that if I die with an outstanding loan, what the insurance company does is they just reduce that loan amount from the underlying death benefit payout. So if I have a $2 million insurance policy and I have $1 million in cash, and over a 10-year period, I borrow that up to $1 million out of there, and I die. And during that time, my wife and I, we've been enjoying that $1 million that's been flowing out to us out of that policy. I'm using it now as treating my retirement as a vacation lifestyle. So we've enjoyed that money. And then I die. Well, you know what ends up happening is the insurance company will then take that $1 million that I pulled out during my lifetime, and instead of paying $2 million to my wife, they'll only pay $1 million because they'll subtract the outstanding loan from the death benefit. So she still will benefit again because I have built-in insurance protection. And I don't have that within my traditional retirement accounts. I only have that principal that I can access until that money runs out. When I die, there's no additional benefit that pays out to my wife or to my kids or anyone else other than whatever the remaining cash is. Now I've had the ability to access that capital to fund my retirement, and when I die, there's a death benefit that will pay out to my beneficiaries. So we'll take a look at how we go about structuring these ways and when we want to use what type of loan. So I have my vault, I have my IUL, I have my whole life participating whole life policy. At any time, all I need to do is contact the insurance company and ask for a loan. I don't have to show proof of employment. They're not going to do a credit check on me. It doesn't matter if I'm retired or unemployed or have a lousy credit score. I have access to those funds at will. And so they'll cut me a check, and while I'm younger, I'm going to pay back that loan. And my vault will continue to increase because that money is still being treated as there. And then when I die, whether or not there's an outstanding loan, that death benefit is made available. But I'm a born consumer. I like to buy items, and one item that I like to get that's definitely my weakness is just in regards to acquiring cars. I get a new car every couple of years. And so what I've always had to do is I've always generally had to finance those vehicles because I'm not the type of person where I'm going to save and save and save and then completely wipe out those savings just for the purchase of a car because now I've lost earning potential on those funds. So I put money aside for investment and growth, but I'm more of a traditional consumer when it comes to buying these big ticket items where I'll go and finance them. So if I want to buy a $40,000 car and I'm going to structure a 5-year loan at 3%, which is pretty average right now, and the total of my payments over that 5-year period will be $43,000, and when that term is done, I'll have a car conservatively valued at $20,000, and then I'll just repeat that entire transaction over again. every 5 years. And for me, it's actually about every 3 years I'm going through the same process. I get the benefit of having the vehicle. From a financial standpoint, it's not the best thing because I'm buying a depreciating asset, but I'm paying these finance charges over to the lender for a depreciating asset. However, with my private vault in place that I have, what I'm going to be doing for my next car purchase is I'm going to borrow the $40,000 out of my vault. That cash is in there. And so I erred on the side of caution and had a higher rate than what is currently the going rate for loans. I put it at 5%. Actually, right now it's at 4.25. But over that 5-year period on that loan, I've actually paid a little bit more money in there. I've paid $45,000. Well, how could that be good for me from a financial standpoint where I'm paying more in regards to financing charges? Well, what we need to do is we need to look at, I have the value of the car, still $20,000. I'll go around and do this transaction all over again. But the money, that $40,000 that I borrowed, the insurance company treated that money as still being in there. And I treated this as a true consumer loan. So I made my payments back over 5 years. And the value, just real conservatively, I estimated 6%. The value of my vault, the value of that cash value within that policy will have grown to $53,529. So I'm still entering into the same transaction I would have otherwise, but now my capital is still continuing to grow for me. And I haven't had to have a credit check, and I haven't had to go through all of the other hassle that I need to do every time I go and get another car. But as an investor, I want to be able to access these funds for investment activity. The problem is not only do I invest in the market, I invest in real estate. It is a major nightmare dealing with traditional lenders right now. They're not investor friendly. They haven't been for years, and we always have to play by the game by their rules. And the most frustrating part from my standpoint is they're constantly changing the rules. Can I have 4 loans out at one time? Can I have 10 loans out there? It's constantly being changed. And I have to jump through all of these hoops. And there's been a couple of transactions where we've just backed away because of all of the nightmare paperwork that they continued to request. And so we lost out on the opportunity to enter into a transaction because the banks made it so unwieldy. And I don't want to have my sole lending source for my long-term real estate purchases be based upon hard money. Because on the hard money, yeah, it's easier to get, but I'm going to be paying a much higher interest rate, which then directly reduces my return on investment. So what I'm going to do, if I was going out there and I was rehabbing, flipping properties, wholesaling properties, instead of dealing with a traditional lender, which they're probably not going to loan me the money anyways on a short-term deal, so instead of dealing with them, I'd have to deal with the hard money. I'm going to take all of those parties completely out of the picture, and I'm just going to borrow directly from my vault. I borrow those funds. Now I'm flipping this property. For those of you guys that are clients on the real estate side, you know that we're using a corporation or an entity tax as a corporation for our short-term transactions, and I loan the funds to my company. My corporation goes out there, rehabs the property, sells the property, and it pays me back the loan, and then I pay the loan back to my policy, all the while funds were growing in there while this is going on. So I'm doubling up on potential return. I'm going to enter into a very similar transaction if I'm buying a rental. I'm going to have my LLC. I'm going to fund my LLC with a loan from my vault, and over time, as my tenant makes those payments, instead of using those rental payments to pay off a traditional mortgage, I'm using those rental payments to be paying the loan back to my vault, and all the while, those funds in here are continuing to grow. Now, maybe I might be in a situation where I don't want to actually borrow the funds out. And there's some tax reasons why we might want to do this, just in regards to being able to deduct interest payments. What I also can do is I can still go the traditional financing route, but I can use the funds in my vault as collateral to enter into a loan. And then it will be the bank that loans me the money directly. So I have unlimited options in regards to how I want to access the capital, just depending upon the transaction. And again, this is all going on while we're younger and we're actively engaged in investing, and we haven't got to those golden retirement years yet. So we're always planning on paying these loans back so the funds continue to grow. So if I want to buy a $100,000 property from a bank, I can structure a 10-year loan at 5%. Total payments end up being $132,000, so $32,000 of it, $32,400 is actually going to be in regards to finance or interest charges, which is still good in terms of now I have an investment property. It's going to kick off passive income to me. But I want to still have the ability to have that passive real estate investment, but instead I'm going to borrow the money from my vault. Same loan structure, 10 years at 5%. I can pay it back sooner. Hey, I can pay it back over 20 years. I'm not worried that if I miss a payment or several payments that the lender's going to foreclose on the property, because they're not. Because those funds are held within my vault, and I'm the one that structures those loan payments. So I still have the $100,000 value of the rental. I still paid the same $32,000 interest charges. However, since those funds were still being treated as being in there, my value in that account has gone up from off of that $100,000 has gone from $100,000 to $133,000. That's a win-win for me. Now I have this $100,000 rental that's kicking off passive income to me, and the underlying value of my vault, my IUL or my whole life policy has continued to grow. Another thing that we can do is we don't necessarily have to take the policy out on us directly. As I said before, the older we are, the greater the cost of the insurance. Or maybe I've had a prior medical condition that makes me uninsurable. I can take a policy out on my child or grandchild or anybody that I have what is known as an insurable interest on. Now, I have two boys. They're quickly approaching college age. So I need to save for their college retirement or their college funds. Well, I'm not a big fan of 529s. 529s are in the same boat as IRAs, and our qualified plans is that they're directly in the market. And so what ended up happening in 2008 when we saw that huge decline is that those funds in those 529 plans, you can only reposition them once a year. And people were locked in. It took an act of Congress after there was a huge loss to change the rule just for that 1 year to allow people just to put it back in the cash. Well, what happens if you were in 2008, you had a child in college, or you had a child that was going to start college in 2009? Oh, that principle got wiped. So what I do is I can take a policy out of my 7-year-old son. And I'm going to set aside $10,000 annually. That will be the annual premium. He's the insured. I'm the owner of the policy. I was going to put $10,000 in a 529. I'm going to put $10,000 in premium on his insurance policy. And I'm going to pay that policy until he's 18. Then, between the ages of 18 and 22, I can stop payments. I can stop payments before that, and it doesn't matter if it's a whole life policy or a universal. As long as we have enough capital in there, we can structure the policy to cease payments at any age, just as long as it can sustain itself. So by the time my son's 18, there's going to be $132,000 in there based upon the projected growth. Well, we figured college is going to run for a public school. At that point in time, it's going to be about $100,000. So we're going to be able to borrow $25,000 a year for those 4 years to cover his college education. Now, we could stop paying the premiums at that point in time, just let the policy continue to sustain itself. But hey, I want to use these funds also to finance my retirement. So I'm going to continue to pay the premiums. And I'm going to pay those premiums until he reaches the age of 44, because at that point in time, I'm going to be in active retirement. Now, the cash value in that plan that I set up for him, that I'm the owner, is valued at 1.5, almost $1.6 million. And that's now another income source for me. I could pull $91,900 out of there for the next 25 years, income tax-free. And what I'm able to do is I'm able to benefit future generations, because as he grows up and he has kids of his own, of course I don't want anything to happen to either one of my sons, but when they have children of their own, I might make their children the beneficiaries of that insurance policy. So if worst case scenario, something happens to their father, now there's money that will pay out for their benefit, for their education costs, for their living expenses, so we can create a family legacy passing down to future generations. So this strategy right here is really good for my clients that are in the late 50s, 60s, even 70s, where what their main focus is keeping the underlying cost of insurance down and giving their children or grandchildren an avenue where you can borrow money from that plan to finance their education expenses, to finance the purchase of a first home for them, or for a car, or whatever you desire, because you're the owner, and it will also help you supplement your retirement. So taking it back full circle, when we had John, where he was putting away that $10,000 a year, and he wanted to have $60,000, and we adjusted for inflation, he needed $100,000. Well, if you recall, we had that retirement gap of $47,000. After tax, he was only getting $24,000. This was out loss, which isn't realistic, but we wanted to have a best case scenario for John. Instead, though, instead of putting the funds all in this qualified plan, let's put that $10,000 into a 7702. And we put the exact same amount, but since we don't have market loss risk, by the time John is 65, from ages 65 through 100, he'll receive $47,789 annually. And it's tax-free. So we've just reduced that income cap for John down to only $13,500 with using the same funds. Also, what we've done, what we didn't have within our qualified funds, is that if John dies at the ripe old age of 100, there's still going to be $1.2 million that passes down to his beneficiary. Taking it one step further to completely close that gap, if John was able to allocate an additional $3,000 over into this plan, that will generate $62,000 annually for him for a 35-year period, and there's no gap. So over that period, he'll end up pulling out $2.2 million. And then again, dying at the ripe old age of 100, there's still almost $1.6 million that passes down to his family. So this is an excellent opportunity in regards to setting aside and growing wealth. I don't think that a person should put 100% of their assets in a strategy like this, just like I wouldn't think a person should put 100% of their income in real estate, or 100% of income in their market, or 100% of income buried in their backyard. The key to a long, successful, and profitable retirement is having diversity in regards to your assets. And this provides excellent diversity because we see nice growth potential without any risk of underlying loss, and the money comes out tax-free. So it is a win-win. And so one of the very first things that I would look at doing is having some type of analysis looking at where you're currently at and where it is that you want to go in regards to your planning. Do you want to look at setting up a plan where you're paying from now for the rest of your life? Do you want to have a plan where you're only paying into it for a couple of years and then it just continues to grow and grow? Do you want to put away funds for the purchase of investment properties? Are you looking to do so for children or grandchildren education? That's the great thing about this, is that you can structure it however you see fit. It's all based upon your objectives. And so what I encourage all of you to do is to contact myself, to contact Clint. A good way to get a hold of me is that via email at gboots@AFS, Anderson Financial Services, plan.com. Both Clint and I can be reached at the 800 number, 706-4741. And the very first starting point, what we would do, because this isn't a one-size-fits-all, everybody has different desires and objectives, we want to get you out a questionnaire to find out how you're currently situated and what it is that you're looking to do going forward. And I believe, Clint, you were going to get a link in place. Were you able to do that?
Yeah. What I'll be doing is sending out the questionnaire tomorrow to everyone that's on the event, so they can download the questionnaire and fill it out and fax it back to you. Okay,
perfect. And what we do is I just look at the information initially, calculate out some numbers on some options, and then we get a conference call set up to go over different planning options, and then we just do modifications based upon that. So you end up having a tailored design plan that will meet your needs. We're looking at setting up a policy right now for an individual that wants to immediately, the day after those premiums fund the policy, immediately be able to turn around and borrow $75,000 from the policy. So those types of things can be done. Another plan that just went into effect is where I have a 27-year-old client that just started his own business and he wants to fund his plan, and so his corporation is funding $6,000 a year for him directly to his plan via an executive bonus structure, and just based upon the projected growth rate, by the time he's 65, he'd be able to pull out $124,000 a year tax-free. So it's really good just to look at what your options are, and if you have any questions, you definitely don't hesitate to contact us.
You know, Greg, I think one point that we might make as well is that a lot of people have an expectation that they're going to have so much money available for them upon retirement, and then when we run we do an analysis of their current situation and what they're saving and what they'll have available, there's often a gap there. And
Absolutely.
So you want to speak to that?
Well, yeah, so what we were looking at during that presentation in regards to John Doe, those numbers, that's what we do for our clients. So we'll look at what it is that you have and what it is that you're setting aside based upon these projected rates, because you're the one that determines, well, what is a nice, relaxing retirement? Is it $40,000 a year? Is it $120,000 a year? And so whatever that magic number is for you, you need to know whether or not you're on track to make those numbers. And if not, you want to find out much sooner rather than later on what you can do to modify your planning so you can get to where it is you want to go.
Yeah, the thing is that I've noticed is that a lot of people now have confidence in the stock market again, and you know, we go through this period over and over again where we have short-term memory that, you know, you look back for the last 2 years, great, the market's been going up, but eventually it's going to turn. And the question is, are you prepared for that return or for that turn of the market? One of the things that I'd like to share with everybody is that, you know, when the market turned in 2008, 2009, we had a standard 401k plan set up for our firm where we've been investing in, and it was a shock. I mean, it took our accounts way down, and they've finally now come back to those levels where they were prior to the market making that what they referred to at that time as a correction. And because of that, the partners at Anderson actually went out there and created our own 7702 plan, knowing full well that should that happen again, because it will, that we're not so dependent then upon making sure that our broker is making the right decisions for us, that the money we're investing is going to continue to grow, and we're not going to suffer with those declines.
Yeah, absolutely. And unfortunately, I mean, everybody, when it comes to market performance, everybody suffers from that short-term memory loss. Reality is, since the end of World War II, we've seen 11 bear markets, and they happen on average about every 6.1 years. So there is another one out there. If whether or not it happens this year or a couple of years from now, who knows? That's the problem. We don't know. And so we want to have diversity, making sure that we're preserving principal for when it is we really need it, whether it's to buy a new car or investment property or to fund our retirement.
All right. I think you hit it, Greg. Thanks for being on.
Hey, my pleasure. Thanks for having me, and thanks all of you for attending. Any questions, don't hesitate to let us know. Have a great evening.
All right, everybody. Have a good evening.